My name is John Vance. I'm the president and founder of Vance Wealth. And this is our annual economic and market update. I've been doing these now for, the past at least 15 years. And I really do enjoy these way more in person when I can have some engagement with each of you. It's a lot more fun when I get Q&A, but I'm really excited about being able to deliver this today as the 2021 market and economic update. So welcome everyone. One of the things before we get into this, I just want to say thank you to all of our clients, to my team, to everyone that we know, especially here in the community. It was a pretty trying year last year for everyone, and one of the great things about coming out and being able to reflect is I love how our team handled things. I love how our clients handled things, and I think collectively as we start looking forward, we have better things ahead of us. So. This was a really good opportunity for me to reflect. If any of you have been to the workshops in the past, you, I'm sure, recall that there's a lot of heavy economic data. I'm going to try to make it really interesting and just have a couple other quick items that we want to get into. So again, this is going to be our 2021 market and economic update, and I've broken this into different slides. And so we're going to be posting some of this through social media into these different topics, and I'm covering different questions. We've been getting a lot of questions, especially over the last 6 months, but we do get a lot of questions ongoing. And so we're trying to address those head on. And I have a question, and then I'm going to actually tee up a response. So what I'm going to do now is I'm going to share my screen and get us into PowerPoint mode. And we should be good to go. Okay. So again, this is the 2021 Market and Economic Update. Learn from the past and make more disciplined decisions. Here's our disclosure. So Vance Wealth, we're an independent registered investment advisory. There's some investment disclosures on there as well. All right, without further ado. So really our firm and what we really espouse to be, our mission statement to help our clients and families succeed at every step of their financial journey, inspiring them to achieve more, being by their side to help make the difficult decisions, celebrate life's joys, and be a trusted partner every moment in between. And we really, that's something that we come to work every day and really try to live up to. We know that our families rely on us, and we take that seriously. And as a firm, as we've been growing and adapting, really been taking on this mantra of think differently, be purposeful, achieve more. And so that's something that's really resonating throughout the office here at Vance Wealth. Our team has grown. So last year at this time, we had just added Patty, a new wealth advisor, and we added Lauren Fox, who's the director of First Impressions. And we had a lot of internal promotions going on. Super excited. Lisa's now our chief compliance officer. Tara has been elevated to the role of director of productivity. So, and a lot of familiar faces that you see on here. So our team has been growing. We actually have a couple new hires kind of coming down the pipeline. So I guess I give you a little bit of info on that today. So, the big headline here is keeping calm even in crisis. As I look back in last year, we tend to do 2 to 3 workshops throughout the year. And last year, just dedicated to Vance clients, we did over 20 webinars. And in the middle of COVID, we were doing the webinars weekly, and then it went to every 2 weeks and then monthly. And so we've really kind of stuck to the cadence of, every month. And we've been getting good attendance. So we hope you have been valuing this. And, going through all of that, looking through the old notes, I mean, there was a lot of uncertainty back in March and April, and still uncertainty today, but much less so in terms of economically. And so, it was really a nice thing to look back and kind of see what our message has been, and hopefully it's been consistent for you and valuable to tune in. And that's really our goal for this year, is make sure we continue to add value. So we made a transition on October 1st. We established our own registered investment advisor firm. And for the most part, it hasn't really met any changes for any of you. All your accounts are still at Raymond James, but it's really put us in a higher level of a fiduciary standard and really a higher level of client care. And so, we're really looking forward to the future. And, we know this move will benefit our clients going forward, just give us a lot more independence and flexibility. So That was a really, I guess, a great thing that happened at the firm level. Future new hires. We're actually going to be bringing back one of our old employees, Chris Pelch. He's going to be coming in as in the role of the Chief Operating Officer. One of the things as we've been growing and serving more clients, more families, there's been more operational demands on me, and I'm really here for running the firm, but also want to make sure I'm available for clients, setting strategies, running the investment committee, and so these are all things that I'm committed to doing, and operationally, to stay strong and to really deliver that world-class experience that we try to deliver every day. We're bringing someone in to really help manage that and to keep us moving forward. So Chris is going to be starting here in the next couple of weeks. Familiar face. He was with us for 4 years before he went back and got his MBA at UCLA. So he's coming back with more mature and more experience. So really looking forward to that. And then community involvement. This year I'll be actually tonight. I'm the incoming chair for the Santa Clarita Valley Chamber of Commerce. So I'm really looking forward to serving the community in that way. And so that's one of the things too. We continue to want to give back to the community. Santa Clarita is really important. We have a lot of clients in Pasadena, and this is, these two local communities are really important to us. So let's dive in. Sorry, I have a couple more updates. So one of the things, we do send you our quarterly newsletter. Hopefully this is valuable. This should be getting mailed to most of you. Some of it are getting this via email. I really hope this has been valuable. This is where we give you a lot of updates on planning ideas. And so that's going to keep coming out. I think our next one is coming out in the next week. And then stay tuned. So if you're not getting direct emails, or if you get most of your data through Facebook, for LinkedIn, things like that, make sure you like us on Facebook. Make sure you like us on LinkedIn, because a lot of our content is getting pushed out in that manner. And that's a lot of times the stuff you see, because I know we all get bombarded with emails. So we're finding connecting with clients, connecting with those in the community is happening more so in social media. So please do like us, and that way you'll be able to stay up to date. A couple other items on here. You can see upcoming events. So we are committed to doing our monthly webinars. Our next one is Tuesday, February 16th. It's at 4:30. This one changed a little bit just because of just some scheduling conflict. I think we had a big power outage. That's what happened last week. So we moved our webinar to today. And then we're doing a chamber webinar also on Thursday, February 18th. So if you can join for either of those, the Tuesday one is obviously the Vance Wealth Achieve More webinar that we're hosting. All right, so if you recall, when I set this up, we're really going to be breaking these down into questions. And the important thing to know is we have a lot of charts in here and data. My job is to really go through and try to answer these questions answer this question to the best of my ability. I don't have the benefit of you asking those questions to me. However, we do have Q&A. So if you remember, just from a housekeeping perspective, if you have questions, go ahead and you can queue it up in the Q&A. We already have a couple questions here. So, but I think what I'm going to be doing is just put them all in the Q&A, and we'll save it to the end, because I have a lot of content to get through and I want to make sure we stay on point. So put it in there, and then I'll be going through the Q&A. We're also recording this, so I want to make sure that I stay on point. So is the stock market overvalued? That's probably the question that we get a lot. And even more so, we get the stock market is overvalued. So instead of a question, it's a statement. And I have, I guess, some different data that we can go through, and we can chat about that. So this is a chart of the S&P 500. Now, what I really love about this chart, this actually is essentially the chart that I've lived through in my career as a financial advisor. I started in the business, graduated college in 1997. So this chart goes back to that period of time. And kind of the early period of time that we had, the markets had a really healthy rally through the end of 2000. And then you can see the volatility along the way. And if you look at the rally that we saw kind of leading up to COVID, you can see we've seen this 400% gain. And so I think by this sheer movement alone, this is what's driving a lot of the conversation of the markets are too high, the markets are too high. And, we probably can point out that there are some periods of overvaluation, but there are a few things that are affecting, and I have lots of data that I'll go into on different sections today. We have a few things that are really affecting that question. When we talk about something being overvalued, and the main thing we have to look at is overvalued relative to what, right? when you're making an investment decision, we have choice of where we put our money. Are we going to put it in cash? Are we going to put it in bonds? Are we going to put it in real estate? Are we going to put it in stocks? Are we going to put it in other places? So overvalued in our estimation is more about what's it relative to, right? What are we comparing to? And so one of the things you can see on this chart, let me see if I can get the handy little pointer here, because I think that'll be a little bit more helpful. All right, the laser pointer. If you see right in this section, it shows valuations. So it does look, by measuring at PE ratios, price to earnings, markets look a little elevated, a little bit above norm. But what's interesting is the dividends, meaning what you're getting from a cash perspective on the S&P 500 is more than you're getting on a 10-year bond. So one of the things that investors are having to make these decisions and saying, okay, do I want to park my money in cash or put it in a 10-year bond that's paying 1% or even below 1%? Or do I want to be in a portfolio of a diversified portfolio of stocks? And so when it comes down to that question, it's not a simple answer as yes or no, because again, it comes back to what's it compared to. This chart shows a great rally, but I'm going to show you plenty of data that just because the markets have rallied doesn't mean we are on that the answer to that question is yes. So you can also see all the volatility that we saw during COVID. The markets essentially dropped 34% and then rebounded 68%. So we finished the year last year positive, which I think shocked most people. When we start looking and start breaking this down into a little bit more of details, we start looking and saying, okay, well, what about what's going on in the market? So there's the top 10 companies in the S&P. They have a higher price to earnings ratio or a higher PE ratio. That's currently at like 33. In historical norms, averages are more around 19 to 20. So by any measure, that does look like things are more expensive. But you look at the remaining stocks; they're not nearly as overvalued or as nearly as high. And so it does suggest that some of the real more, I guess, the bigger 10 that we all are familiar with. I'm going to try to stay out of naming names today with the portfolio or with the different stocks. But if you look at that might suggest that maybe the top 10 are getting expensive, but the remaining basket of companies is not overly expensive, especially given what the future might hold for interest rates and things like that. So you can also see, look at the weighting of the markets in terms of the cap weighting over here. So we're looking at the weight of the top 10 companies is now kind of at peak levels that were seen back in 2000. Now I know that 2000 level makes people nervous because that was a time where where obviously it was right leading up to the dot-com crash. I don't think just because we're there that we should be drawing that correlation that's for sure going to happen. But I do think that's kind of interesting to see that the top 10 companies are driving about 28% of the value. As we start looking at last year, this was what was pretty fascinating. So this is performance by some major sectors, right? So on the left-hand side, you can see the sector of online retail, right? So we all know the big one there is Amazon. So the returns by, let's say, Amazon and others in that area were up 69%. And then we take it all the way to the right-hand side and we look at, okay, what industry struggled? It's not a surprise. Airlines, energy, those were down 30%. So in the span of this past year, you can see certain sectors had a great year and other sectors were devastated by closed down and by the lockdown. This makes sense with the economy being shut down. That had an impact on energy, on gasoline prices, on airline travel, things of that nature. So pretty fascinating. I don't know if this is the widest dispersion that I've seen in my career, but it's definitely one of them where you're starting to see that parts of the market might look a little bit overvalued, but there's plenty of the market that has not been participating. And assuming the rollout with the vaccine and things moving forward and the economy on a reopening basis, there's plenty of companies out there that likely will be exhibiting some really good value. And now this is just a reminder. We do have some slides in another part of the presentation that deals with volatility, but this is a reminder that volatility is normal. So this goes back 40 years, and it looks at gains for the year, which is the bar charts. So that's what the total gain was for the year. And these red dots show intra-year volatility, which means throughout the course of the year, we know the markets go up and down, and that shows the largest sell-off from any peak to bottom. So last year that happened down 34%. We all remember that. That was at the height of COVID starting and the lockdown starting. we had a sell-off of 34%, but we finished the year up 16%. Last year, we had about a 7% sell-off, 2019, we had a 7% sell-off and a gain of 29. So this just shows that intra-year volatility is very normal. We get that a lot of questions from clients like, well, why did this happen? And really the short answer is it always happens. It happens for different reasons, but this always happens. This is just part of, being a long-term investors. And, this normally is about a 14% sell-off. So if you look up here, average intra-year drop is 14%. But the most important thing to focus on is that over this 41-year period, that positive returns happened 31 out of the 41 years. And this is the long-term chart. So I have a lot of people who are like, well, you're wrong about this, or the stock market is overvalued. And one of the things that I like to kind of come back to is that markets tend to go through these long boom periods, and then they tend to go through, we could call it a bear market, we could call it a sell-off, we can call it recessionary environment, or we can call it consolidation. And consolidation in my mind is when you have a market that goes sideways, right? So if we look back, we're going to go through a couple periods of time. We had the roaring 20s where the markets went through the roof. Then we had the Great Depression. And then we had kind of this period of the markets going sideways from the Great Depression through the New Deal, post-World War II America. Then we had the post-war boom, and that lasted about 20 years. Then we had the 70s, Vietnam, stagflation, oil shocks. The 70s, the market went sideways. And then we had the massive boom during the 80s and 90s. And then we had the tech bubble peaking in 2000, and we went sideways. And then you can see we've kind of been on this path upwards. So by a lot of measures, when we start looking at how strong this recovery has been, that up 400%, the recovery that we saw in the 80s was over 1,000% gain. So we actually do think, and we don't have a crystal ball, and we're not in the, even though we're doing an update today, we're not in the business of trying to predict the future because you really can't. I mean, we're trying to make educated decisions, but one thing we know over time is, markets tend to go higher. And so we still think we have room to go. And I have, again, a bunch of different slides in here that we'll spend some more time on today. Okay. Next topic is, did COVID-19 create an economic depression? And yes, I'm using the D word, depression. So if we were just going to look at things like GDP, unemployment, those types of measurements, the short answer would be yes. Because when you have GDP drop in one quarter, and you can see this kind of in this box, 31%. That was the largest drop we've ever seen in any quarter. That is by definition, kind of at the start of a depression. Now, we can sit back today and recognize that that did not happen, but why didn't it happen? It didn't happen because we had massive stimulus. We had stimulus from the government, and we had stimulus from the Federal Reserve. So that was super powerful, and it obviously kept the economy moving forward, whether it was providing resources to small businesses, providing money from unemployment benefits, direct checks. I mean, we had a stimulus coming from everywhere, and we continue to do so. But one of the things that it really reminded me as I was reflecting and looking back at this past year is, because America is such a wealthy nation, because we have so many wealthy companies, because we have such high prosperity, we were able to go through a full shutdown, or I guess I feel like it's a full shutdown in being in California. We went through a partial shutdown of the economy, and we were able to weather that storm because we were able to throw money at it. Now, I realize when we realize when you're coming from a wealthy nation or a position of having assets, which our government does, our companies do, it allowed us to print money, to put stimulus out there, and our economy kept moving forward, and it kept and it's on a healthy way towards recovery. But that only happens because of how strong our dollar is. That only happens because of how strong and how wealthy our country is. And so it's a healthy reminder to look. And there's other parts of the world that are doing okay, but there's plenty of parts of the world that aren't doing okay, that couldn't shut things down. And so we feel really fortunate that this idea that had it not been for all the things put in place, that potentially we could have had a depression. And I think it made, whether you agree with the lockdown or not, that's not what I'm trying to debate. It is more that it did happen, and based on that response, we have been able to weather it. We're definitely not out of the woods yet, but we've been able to weather that and move forward. And these are all some of the real staggering numbers. And so this was in February. This was kind of like what happened in February. Look at some of the things that just fell off the cliff, right? So we saw things like, okay, when we start looking at these year-over-year changes, we had things like applications for mortgages, hotel occupancy dropped by 69%. Travel and navigation app usage dropped by 82%. US seated diners dropped 100%. TSA traveler traffic dropped 96%. So massive changes, right? This all looks like a depression, but because we threw so much stimulus at it, we're getting back to some normalcy in a lot of parts of our life. And so that was very refreshing to see that. And one of the things that's pretty fascinating is I get this question a lot. While I am happy with how the economy is starting its recovery, we're still not a full open economy, so it's going to take some time. I get the question a lot, well, why does the market keep going up? Because the economy and individuals are still struggling, right? There's parts of our economy that are not doing well. So what we're looking at here is on the left-hand side, it shows where all of our GDP comes from, right? Where all the economic activity comes from. I mean, you can see some of the top ones are government, agricultural, miscellaneous services. That's a big one, right? You can see down at the bottom, technology, right? It's not driving a lot of the GDP. And then you look at the middle one. This shows employment. So this actually shows November 2020 employment. So this middle one shows where are the jobs, right? So what's pretty fascinating is that you can see the top box, 36% of our jobs are in government-related sectors. You see at the bottom, 2% of our jobs are in direct technology-related sectors. And then when we look over at the right-hand side, December 2020, the S&P 500, this represents the index value of these companies on our exchange. 38% was in technology. So that's one of the reasons why the markets were able to rebound quite quickly, is because where our economic activity comes from, where our jobs are, is not directly tied to where the industries are in terms of their valuations. And a lot of the tech, especially the tech area, has been thriving because they're able to do so. They're able to create mass scale without a lot of human resources, right? They can use technology to really scale that up. And so when we just kind of finish this thought is, it did create this depression-like environment, but because of the resources we're able to have as a nation, it really curbed that as a whole. I know there's still plenty of pockets of pain, and that's not going away. But from a large scale, when we look at our whole U.S. economy, feel very fortunate about that. All right. I'm going to move some things around when I'm trying to see. Is the U.S. economy healthy? And what is our outlook for the future? So we hear a lot about debt. We hear a lot about government debt, primarily the federal government. I don't know where we're at right now. I might have a slide in here. It may close to $30 trillion, somewhere in that neighborhood. We hear a lot about municipal debt, right? State of California, other states around the country. Those are two big areas where we have tons of concerns. But what's really fascinating is when you actually look at the consumer, meaning us as Americans, how healthy our let's say our balance sheet looks. If you look at the amount of debt we have, which is down here, it's about $17 trillion, right? Big number on anytime you're counting in trillions. And you can see 66% of that is for mortgages, right? To be a homeowner. And you look at our assets, we're at 140 trillion. So any of us were to look at this scenario, whether it was you as an individual or looking at this objectively, when you have that level of assets relative to debt, that seems very reasonable. So one of the areas that we know we're really healthy in is from that perspective, from our own consumer perspective. And we'll talk a little bit more about government debt on a few future slides. But one of the things that's really important is if you look over here, household debt service ratio. So household debt service ratio is debt payments as a percentage of disposable personal income. So basically the ability for us to spend and the ability for us to service debt. Look at where we are. We are at essentially 40-year lows, right? That means that in order to pay, whether it be student loan, mortgage payments, credit card payments, all of the above, auto payments, that we're down at this really low percentage. And that's because of how low interest rates are. So that's really impacting the consumer in a really positive way. So when you start looking at what's going to drive our economy going forward, one of the reasons why we're not overly pessimistic about the economy is that the consumer is really healthy right now. And again, I'm talking about broadly speaking, because we do know there are pockets of the economy, there are pockets of individual households that are struggling. But we're just talking about on a broad scale. As we start looking at long-term drivers of economic growth, and we start kind of evaluating, what really drives things. If you look at the far right-hand side, this is probably the most important part of this slide, is what drives GDP, right? What drives our economic output? And there's a couple things on there. So we have growth in workers, we have growth in real output, which is really productivity, and then we have growth in real GDP, right? So what is real GDP? That's adjusted for inflation. And so the only way for our economy to really be healthy is we need the economy to grow at a fast pace. We'd like it to grow at 3 and 4% because that means we're creating jobs, we're creating wealth, money's changing hands. And we've kind of been stuck over the last 20 years in a lower growth environment. You can see GDP was around 1.8% for the decade of 2000s. And then this last decade, we're about 2.3. So it is trending a little bit higher. But one of the big challenges we have right now is growth in workers. And that, I think, is probably going to fuel probably some big changes in immigration policy, because it does look to me, and I know unemployment right now has really pushed up, so that might resolve itself. But we don't have enough workers to really drive our economy forward. And we do have an aging population, so that's gonna be something as a nation we're gonna have to deal with. But I'm pretty confident that we're gonna deal with this. The other thing, we're probably gonna start seeing a raise in productivity. If you would have asked me with technology, with being able to use Zoom, to use computers, your smartphone, things like that. Now we know it can waste time as well, but from a business perspective, it can create a lot of efficiencies. If you look at where productivity has been going over the last 30 years, it dropped from around 2% in the 90s down to 0.9. So this next decade, we'll probably see productivity rise. With the COVID shutdown and people working remotely, we might actually see productivity go up quite a bit because we're not seeing people commute as much, working remotely. That could be a really nice, healthy driver of our economy going forward. Don't need to travel for work, things that can keep people home and hopefully be more productive. Okay, I did know this was in here. So this is our 2021 federal budget. So total spending of $5 trillion. So that's what it costs to pay for our government. And the borrowing, we're projected to borrow 1.8 billion. This is just our normal budget. This is not COVID spending. This is not a stimulus bill. This is just our normal budget. So clearly we have a big shortfall, because if we're already at 1.8 billion, we're gonna be borrowing more money to pay for this. And so this is one of the troubling signs that we did talk about. The consumer looks really healthy. Federal budget deficit is getting extended, but you know what? With low interest rates, they're borrowing money. The 10-year treasury is below 1%. The 30-year treasury is at 2%. Politicians haven't been forced to make tough decisions because they don't have to, because interest rates are so low. If interest rates were at 10%, growing this deficit would be a lot harder. And so, hopefully we'll start having some shifts in the mentality of spending. I don't think that's going to happen until we get through COVID fully, and that's probably a couple more years to get through it, and also, any of the residuals that's occurring. So you can see where we're spending dollars on Medicare, Social Security, defense, non-defense, interest expense, and so that is a big challenge. That's definitely a headwind, but I will warn you with that. With that is, since I've been in this business, I remember even in high school and junior high and late elementary school, I was told how bad the deficit was. And we've become the wealthiest nation on the planet, or at least maintained being the wealthiest nation on the planet for the last 30 years, even while we were growing this massive deficit. So we've been hearing how bad it is. I mean, at some point, I guess we got to pay it back. But at the expense. One of the things that the government did brilliantly this time versus in the Great Depression. In the Great Depression, they pulled back on money. They basically pulled money out of the system. We fled the system with money. That was one of the things that we learned from that. And that while it does raise deficits, it keeps the economy from spiraling down into a place where you can't repair from. And so that's not happening. That won't happen in our country. One of the things that's key, and this is something that, when we start looking at where some of the changes, as we move forward are going to have to occur, is going to be on the education side, right? Because if you look at where unemployment rates are based on the type of education you have, it's highest when you don't have a high school degree, and you have the lowest unemployment when you have a college degree. That's true also for wages. So you can see the average annual earnings, it goes up dramatically when you go from a high school to a bachelor's degree to an advanced degree. And that's going to be something we're going to need to pay attention to. The good news is we have the greatest colleges in the world. And so that should be something easy to fix if we get some of our politicians to get focused on that. Or maybe not politicians, maybe we get entrepreneurs to focus on that. All right. So our next topic is the Roaring 20s. Can this market rally continue? So you're seeing some themes we're having, obviously, going through some of these topics. And this is not a new one. I shared this with you last year. It's just a healthy reminder that I want to go through. So this was the 1920s, and now we're in the 2020s. I don't think any of us planned for what the year 2020 was going to be. When we start looking ahead, are we truly on the verge of technological breakthroughs? And when you look at some of these pictures on here, from artificial intelligence to 3D printing to the 5G revolution to gene mapping, gene editing, DNA sequencing, there's clearly lots of innovation that's coming. Now, it's laughable, right, to look back at 100 years ago, but this was the technology of the time. This made a lot of households a lot more efficient, more effective, and it built a lot of that, the family structure here in America. But this is the next Roaring 20s. So this is designed to illustrate this concept around markets tend to have what we call kind of flat consolidating periods that can last 15, 20 years. And then we go through expansionary environments. And expansionary environments is when we have massive innovation. So I'm not going to go through each line by line, but if you just think about, we had the consolidation period, and that's putting it mildly, the Great Depression, 25% peak unemployment, and obviously World War II, where we saw the markets essentially go sideways for about 20 years. Then we had this 500% increase in the S&P 500 from 1950 to 1968. And that's when we have massive transformation in the airline industry, interstate highway systems, automobiles, and telephones reach critical mass, meaning being in most people's homes. And these were all kind of the brand and the drivers of that period of time. Then we go through this period of the 70s, right, where we had war, we had stagflation, which basically means inflation but no growth. We had the oil shocks. We had mortgage rates, right? You talk to anybody who bought a house in the late 70s, early 80s, mortgage rates as high as 20%. And then we hit around 1982, and we saw the best wealth accumulation in the history of the US, the history of the world. And that's when we really saw the advancements of globalization of American brands that you see here, like Coca-Cola, Nike, Procter & Gamble. We had, PC penetration, which was Intel and Microsoft and Apple, and then the big box retailers like Walmart, Home Depot, Costco, right? And this really revolutionized and drove massive change, because not only were these American companies benefiting from American profits and American consumers, but they became global. And so by having that global reach, it really allowed for expansion to be even greater, because it wasn't just an American phenomenon, and it was a worldwide phenomenon. So then we go to where we are today. So we all remember, and this is the early part of my career, and many of you have been clients since then. We lived through the 2000 to 2013 timeframe, where the markets essentially went sideways through another war. We had 9/11 during that period of time. We had the technology wreck, or the internet.com bubble, and then we had the consumer debt bubble, which was the Great Recession. And you can see we went through this consolidation phase, which was another 10 to 15 years. And now we're looking at, okay, where are we today? And we do truly believe that this next decade is going to be strong because of the massive amount of disruption and innovation. What COVID did was accelerate it. We were on this path to more Zoom, more Netflix, using teledoc, right? Telemedicine. We were already on this pathway. What it did is it accelerated from a 2, 3, 4, 5 year rollout to immediate. It also forced it with generations that may not have chose to adapt. People like my mom, who's in her 80s, right? She had to adapt if she wanted to stay connected using an iPad, right? Things like that, using FaceTime. And so this really forced us to change behavior in a way that millennials and the younger generation is already doing it, but it really forced the rest of the nation to kind of catch up. And so this is having massive transformation. This is having a massive transformational change in the food industries, how we consume our food, if we get food delivered, the quality of foods. In banking. You know, the idea of a physical bank, that's changing, right? A lot of people, you don't even use a bank. Why would you need a bank? You can just do it all on your phone. Mobile services, you know, all the things that you can do on your mobile phone, content creation like the Netflix of the world, and then treatments for major diseases. This is probably the one that we don't see a lot of, but because of the all the gene editing and genome mapping, or the DNA mapping, it's really making how you treat major diseases. It's a lot more efficient, and that's going to be where a lot of dollars are spent. So it's a big area of growth. And I know a lot of people are constantly pessimistic about our future. I think it's a mistake. I truly believe that when you start looking at what this is going to do, this disruptive period in our time, there's going to be certain industries that are going to fail. But there's going to be many that are going to thrive in this dynamic. And that's one of the things is the markets are shifting. And, you know, we want to make sure as investors that we're shifting with it. You know, we still need to diversify, but we want to be making sure we're shifting for our kind of next reality of what's happening in the markets. All right. So the federal, next topic. Let's see. What is the Federal Reserve doing with interest rates and printing money? Is inflation on the horizon? So that's a question I get a lot of. The short answer is they're printing a lot of money and they cut interest rates to essentially zero. Is inflation on the horizon? Probably, but when? So when we start looking at this is the interest rate history going back around 20 years. And so you can see where we are now. We've essentially cut rates to zero, which is why you all know your bank accounts are paying you almost zero. Bond rates are really low, between 1% to 3%. And you know that's likely the reality for the next couple of years. From estimations coming from the Federal Reserve, they've talked about rates staying low until about 2023, which would give us another 2 years plus. And so that's still to be determined. But one of the things they are trying to create a little bit more of, they do want to create some more inflation. They want to create more inflation in the system because of the amount of debt that we have, because of the amount of printing money that we've had, having a little bit higher inflation actually makes things work a little bit better. And I guess it's the flip side of deflation. I think the Federal Reserve is really fearful of prices dropping, because if prices drop, then paying off debt in the future becomes a lot harder. So creating a little bit more inflation, I think that's going to be their goal. They want to grow the economy faster, get unemployment rates down, and start trying to cause inflation. And really, for the first time that I can remember, it might be the first time ever, it's hard to go back and say ever, but that the Federal Reserve has been consistently, or has mentioned in their meetings that they want to create a little bit more inflation. So instead of at 2%, they'd like to see it printing at like 3% and even 4%. Not for a long period of time, but they'd like to see it get up there, because there's been such little inflation for so long. They feel like they got to catch up a little bit and push that up. Now, moving minimum wage rates up might help with that, right? Because that means cost of labor goes up. So there's definitely some factors in this that are likely going to cause a little bit more inflation. But I think when people ask me about inflation, they're really asking about what inflation that they remember back in the 70s when we had hyperinflation or runaway inflation. We don't see that as a real big likelihood. We think we're going to be in a low interest rate environment for a while, and a low to moderate inflationary environment. But a little bit of inflation would be okay. You can see here's kind of where we have been sitting in terms of the inflation rate has been coming down over the last 10 years. And so, the Fed's target is 2%, but they've kind of talked about their Fed target maybe being a little bit higher. Here's what's happening with the printing of money. Now, I know for us, it gets to be confusing when we talk about printing of money. Well, what does that actually mean if you're printing money? Well, that just basically means a couple things. Primarily, it means the Federal Reserve is increasing their balance sheet. So if you look back in 2008, they had about $1 trillion. Right now, we're pushing that up to 7-8 trillion. So this is just printing of money, right? This is money that's going into treasuries. That's money going into other products. They're using this balance sheet to kind of stabilize the market. So in the middle of COVID, what happened was so many people were liquidating positions. Government came in and really stabilized things by expanding their balance sheet. It can't go on forever, we're told, but it's definitely something that's continuing to occur until we get through COVID, and then once we get through COVID, those will likely kind of make their way back down. This is just a reminder of interest rate policy. So in 1981, the 10-year Treasury was at 15%. That means if you invested in a Treasury, you could get paid 15.8%. And where we are at the end of the year was 0.93. So that's a massive collapse in interest rates. That's what we've been living through over the last 40 years. It's another reason why I've been talking to many of you and you're super excited because you just refinanced your house at below 3%. So the reality is low interest rates, it's bad for cash, right? It's bad for fixed income. It's bad for bonds because we're getting low returns on those. But it's good news for debt because then you're able to purchase a car at a lower rate, buy a house at a lower rate. And so student loans at a lower rate. So the borrowers are loving the low rates. The investors are not loving the low rates because of the extremely low, especially after inflation returns. And then this just adds a little bit more on top of this. So if you look back to the 30s, this shows that what were the bond returns in yellow by decade, and then what was the starting interest rate? So basically they're matched up. So right now, the expectation is if the 10-year bond is paying 1%, that means when we look back 10 years from now, what will the return be on the 10-year bond? It'll be 1% per year. So obviously that's, if you think about on a bond after inflation, that's a negative interest rate, meaning you're getting less, you're getting less than the inflation rate, which is not good. Now, I know I can't have a conversation with you. Many of you say, well, why do we own bonds then? Bonds are good diversifiers. Bonds hold their value when stocks go down. Bonds hold their value in more volatile environments. And so that's why it's an important part of diversification. But it's also, the reality is we're looking at a really low rate environment for at least the next 10 years. All right. I told you I got a lot of topics we're covering today. Next topic. Why are we investing in international equity markets when the US is doing better? So that's a question we get a lot. Why are we investing overseas when US is clearly the leader? So when we look at kind of this, I guess we can kind of, I'll put this dot here, really the post-Great Recession recovery that began in 2009. If you look at the previous year, or the previous decade to that, international markets did a little bit better, especially in that period of 2003 to 2008. You can see the purple line. And then if you look at what we've just been living through, is that the US markets are up about 400%. The international markets are up around 143%. What happened during COVID was about the same. They lost in mid-30s, and then the recovery a little bit higher for US, but pretty close. So when we actually look, so this is the chart. So if we go back and say, okay, hindsight's 2020, what should we have done? Well, we want to maintain diversification because that always wins over a long period of time. But when we look at actually what did better, being heavier in the US paid off. If we then say, okay, well, what do we do going forward? So if we look at a few things and we price to earnings ratio basically help us to measure where the market's expensive or cheap. Higher ratios tend to be more expensive, lower ratios tend to be cheaper. So right now the PE ratio is about, in international, is about 75%, meaning it's 25% cheaper. Historically, that number is 13% cheaper, so we're at a bigger discount than normal. Here's a couple other fascinating things. If you look at dividend yield, right? So this is cash paid by the investments, by the equities. The S&P right now is 1.6 and international is at 2.7. which means international is 171% or 71% above what the US is paying, right? So when you look at it on where we're looking at from a valuation perspective, look a little cheaper, and then also from a dividend perspective is providing a stronger dividend. So that right there is a reason why looking forward, you should maintain the diversification. When we're also looking at, and I know we start getting into some heavy items on here. So this just shows when international was likely expensive, and this was back in 2009, 2010. The last time international outperformed was starting in 2003, and it had a really healthy run. So right now we're kind of back at these levels, which means, you know, we've seen a little bit of a recovery there. That just means we think that there's some attractive opportunities from an international perspective, but we still are way overweight US. We just want to make sure we maintain the discipline because I think a lot of investors are getting a little bit weary of holding on to those positions, and we think it's about having discipline, maintaining diversification is what's going to win over time. And one of the things that surprised me, so when we look at what happened from a stimulus perspective relative to the size of the economy, you know, we know that the US threw a lot of money at it, right? So if you look right here where the red is, this shows the US. So the US threw a lot of money at it, but what was pretty surprising and this is a percentage of the economy, the US did it through spending and revenue measures and not through loans and kind of guarantees. And if you look at contrast that to Germany, right? Germany provided a lot more stimulus, but they did it in the form of more loans and guarantees and less in spending. So essentially that would be like, instead of using the PPP and saying, here's all this money, it's yours, is letting businesses borrow and they have to pay it back, right? So US did not do a lot of that. And a lot of these other, especially European, you can see Japan, they did it through that. This does probably speak a little bit to our economic strength. I don't know if the rest of these nations are as strong as we are to be able to just spend the money. But it does show that, you know, while we start looking at recovery on the horizon, you know, while US was a big spender, there's plenty of other countries that provided some massive stimulus that should help these countries mend. But again, this is all under the umbrella of maintaining global diversification and not getting over concentrated in any in any one country. US is going to be the dominant position, but we definitely want to make sure we continue to maintain some international exposure. And then this just kind of shows periods of time when you have, you know, US versus international stocks. So this red shows, this goes back to 1980. When US outperforms, you can see these periods of time. So we can have long periods of time where US outperforms. We can also have long periods of time where international outperformed. So based on current valuations of looking at US to international, historically, we're at this 18% threshold. We're at 31. All this is telling us, and it's kind of the same data that I showed you throughout, is that the international markets are poised to be a little bit more attractive, and it's possible we might be on the verge of kind of this leadership changing. The timing of it is really difficult. It's just, again, maintain that diversification. All right, next topic. The US stock market is really high. I guess that's another question, is it overvalued? But it's a different way of putting it. The US stock market is really high. What should I be doing in my portfolio? So the big message here is be an investor, not a trader. Now, if you start thinking about what's going on in the markets, we're seeing headlines every day of Bitcoin and all these crazy stocks. I don't know if you've seen recently, some of these stocks have been, you know, going up and down 100, you know, up 100%, down 50%, you know, crazy amounts of volatility. It's now kind of all over the common press. I think there's going to be some more regulations put in place to deal with this, but this is dealing with like trading and speculative behavior. So the whole idea is like, what should I be doing? The most important thing is be an investor, not a trader. And if you look at this data down here at the bottom, it shows, this is a study done by this Dalbar Institute, and they show over here that over the last 20 years, the average investor, their rate of return has been low. It's been 2.5%. At a time where the S&P 500 has averaged 6%. And well, why is that so low? And the gist of the reason behind this is that investors tend to make the wrong decisions, right? When things are going up and going higher, people want to buy more of it. And when things go down, they tend to sell it. And that's what leads to poor results. So the whole key of what you should be doing now is a thing called rebalancing, meaning that as you look at last year, and these are things we are doing proactively for you, as you look at last year, we have some big winners. We have some things, and we'll share this with you in our review meetings. We have some big winners. We're taking some profits off that. And then we're looking at reinvesting in some of those that maybe didn't have a great year, maybe are better value. And so those are the things we're looking at and so the theme here is be an investor, not a trader. And here's why we want to have that mentality. If we look going back over the last, I think it's a 70-year period. So this shows the 70-year period, and we're just going to focus primarily on this green color, which represents stocks. So it represents the S&P 500. So on a 1 year, basically kind of rolling basis, the best return in the last 70 years is up 47%. The worst year was down 39%. When we then start going out in different time frames, so that kind of gives you a sense of what you can expect in a 1 year basis, up 47, down 39, right? That's a pretty wide margin. Then when we start going into different periods of time, it says, okay, well, what if I looked at over the last 70 years? What about on a 5 year? Well, look at this. The volatility to the downside goes way down. It's averaged down 3%. And the upside, the best is up 28, pretty substantial. Then we go to a 10-year period where the downside is down 1 and the upside is up 19. And then we go out on a 20-year where the lowest return over a 20-year period over the last 70 years was a 6% annualized return. And the best was a 17%. And this is why there's always this focus on having a long-term outlook, because even though the short term, as exhibited here, can have a lot more volatility to the downside, the chance of success as you have 5 years, 10 years, 20 years, the chance of loss goes down quite a bit, and the chance for having positive returns goes up quite a bit. So predictability over 10 and 20 is a lot easier to do than predictability on a 1 year. Now, this just shows the unfortunate reality that we're living in about cash. So back in 2000, you could get on a $100,000 savings account, you could get $6,000 of interest from a savings account. That's what this chart shows, 6,000. So that means if you had $1 million, you could get 60,000. If you had 10 million, you could get 600,000. So you can see what's happened to cash. Look what we've been living through since 2009. Cash is in a really low rate of return environment, and look at where we are today, 200. So in order to basically beat inflation, your cash needs to generate 1,600. In order to beat education inflation, it needs to beat 1,200. And in order to beat medical care inflation, it needs to be 2,400. So that's why cash is important as a safety net, as a parking place. It's not an investment place because for a large sum of money, it's for emergencies and it's for safety, not for investment, because the rates of return are below inflation. This also shows on the bottom income rates, where we can get income from. And it's pretty crazy how low rates are. Even on this category, let's say US high yield, which is another word for junk bonds, it's only paying 4.2, where historically those rates are like 8% or 9%. So interest rates have come way down on pretty much across the board, which is making it harder and harder for investors, for retirees to live off that income. So a big part of diversification is you're going to get income from these different vehicles. However, some of your return is going to have to come from capital gains or capital appreciation. But with that comes some investment volatility, some investment risk. So that's what we're looking at here. Don't shoot the messenger. Obviously really low returns on the 10-year, or yield, I should say, on that. Now, a lot of times I like to show this diversified portfolio can work even when it basically when it doesn't feel good, even though it never feels good. This is a really important slide to kind of illustrate how we, I guess, function from a investor psychology perspective. This is a total hypothetical portfolio. This is a slide put together by BlackRock, who's a large institutional portfolio manager, but 40% US stocks, 10% international, 5% small cap, 5% emerging markets, 30% US bonds, 10% high yield, right? So a diversified mix, not necessarily the mix that we have, but just a diversified mix. And what it does, it goes through periods of time, periods of time where we're just measuring against the S&P, so just the US market against a diversified portfolio. So in this 2000 and 2002 period, the markets lost 40%. A diversified portfolio lost 17. What's our emotional reaction? I lost money. Then we go through the next cycle where S&P made 82 and a diversified portfolio made 80. And then you said, I didn't make as much. Well, it's close enough. Maybe you don't feel that way. In 2008, S&P lost 39. Diversified portfolio lost 24. I lost money. And then we have this 10-year run where the S&P made 350% and a diversified portfolio made 195. I didn't make as much money, right? That's the emotional feeling. And then to 2020, kind of pre-COVID, S&P lost 30, diversified portfolio lost 20. I lost money. And then the recovery up 70 versus 42, I didn't make as much. But when we add all that up and really look at a 20-year time frame, the S&P is up to up 268%. The diversified portfolio is up 275. So even though at all those emotional stages we have either I lost money or I didn't make as much, diversification can work even when it feels like losing. So it's just a healthy reminder of like dealing with this. And we're getting a little bit of this right now where, people want more technology and more high flyers because of this feeling of, of this idea is I didn't make as much. But it's really important to keep that this chart in mind when we start talking about being diversified. All right, doing good on time? Next topic, with all this volatility, why should I remain invested with a long-term approach? Well, first thing is that volatility is really the price you pay to be a successful investor, and volatility is the price you pay to generate healthy returns, right? People don't give you high returns for low volatility investments. So part of the reward of being a long-term stock picker is you get you make over time better than cash and better than bonds, right, historically. But with that comes volatility. So we're just looking here at, not quite the last 30 years, but you look at these periods of time where we've had some massive corrections, right? 1998 down 19%. The correction in the dot-com was down 49%. The financial crisis down 56%. Then we had these blips along the way, down 18, down 10. Gotta check this real quick. Move something. Down 13, down 19, and then COVID down 33. Right? These were all pretty substantial corrections, and depending on the level of your wealth, that could either be a $100,000 correction or it could be a few $1 million correction. Right? So when we start talking about percentages, when you look at a chart, it's like, okay, I get that that's normal, but as investors, the hardest thing is that we make money in dollars, we lose money in dollars. And so percentages are nice to see, but when you look at the portfolio, sometimes that dollar volatility can be shocking. But this is normal. This is not going away. And a lot of times people are asking the question, well, why is this occurring? You look at all these reasons: Asian financial crisis, the post-tech bubble collapse, the global financial crisis, right? There's all kinds of different reasons. We almost don't care why. We just should accept that it's going to occur and diversify and plan accordingly. And diversification means you have some safe assets that don't generate a lot of return, and you have growth assets that generate higher returns along with higher volatility. But just embracing this is really important. And this goes whether you're 80 years old and maybe you say I don't have a long time horizon, or you're younger and you're in your 20s and you're trying to build. It's really important to be embracing this idea. This even goes back even longer. I can send you this slide if you really are enjoying kind of the nuances of some of this, but bear markets and subsequent rallies. And this shows that we basically have had 13 bad bear markets going back to the Great Depression. And that basically is a decline of greater than 20%. So if you think about it, we've had 13 going back almost 100 years. It's not that often, but it is inevitable. And that's going to happen in the future. And potentially with, how data and the ability for markets to move, we might be in a world where we see more of this occur, and this might happen more frequently. But the one thing is, in all these scenarios, the markets had rallied back, and it's not guaranteed that that's going to happen. But if you're a believer that over time the economy is going to move forward, that the economy is going to grow, that our company is going to innovate, that's where you start having the faith in that. Yeah, we have recessions, we have slowdowns. And that's all part of being a good investor. And there's tons of dates on here and data that I can share with you if you want this. I'm not gonna, I'm gonna spare you tonight because I know there's a lot of details that I'm going through. So I went through a hypothetical here because you can see here, it says growth of $1 million with volatility. So I made some assumptions here. I said, okay, look at the three choices down here. We have the orange, the green, and the gray. And I'm gonna have two charts on this. So the orange just says, well, what if I make 1% on my money for the next 30 years? That means $1 million grows to 1.3 million. Not super excited because we also know relative to inflation, you're not making any progress. In fact, you're losing progress. So then I said, okay, well, we're going to take the gray line. Well, what if I just made 6% on every year? And that means your $1 million grew to 5.7. Now this assumes you're not taking money out, right? So this is just the growth of it. We can do a different chart for spending it, but if you're just growing it. Now, the challenge with this is we know that markets aren't linear, meaning they just don't give you 6% this year, 6% next year, there's volatility, right? So I just said, all right, well, if you get this 6%, then your million grows to 5.7. What the green line shows you is the price you have to pay to be an investor. So we used a 6% hypothetical return, which is what we would call more of like a balanced portfolio, like 70% in growth, 30% in fixed income. Kind of that target. Again, it's just hypothetical, but the green represents basically a 20% correction every 5 years, right? So we're looking at, you can just see the corrections. And so I don't know if I can actually select the data, but essentially if you imagine as the markets are going up from 1 million and hit the 3.2 million mark, when you get a 20% correction, at that point, it's a $650,000 correction, right? And so that's part of being an investor is in order to get these returns, you can't expect this to be a flat line up. You're going to go through these ups and downs, and that's normal. It's got to be understood and it's got to be embraced. We can't time the market. We don't know when these are going to occur. We don't have the chart ahead of time. Anytime we try to time the market means we get out, we're guessing, and we're not in the business of guessing. You shouldn't put us in the business of guessing. We want to be a long-term investor, and I don't care so much to miss this dip. I want to get to here. So how we get there, I don't care as much. I just want to get there. And so if you're trying to get too cute and miss these dips, that disrupts your path because you got to get out right and get back in right. Now, if I show another chart, this actually shows us, well, what if we made 9% on our money? So this would be like a 100% growth portfolio, right? So you had no fixed income, all growth. Not very practical for most people, but if you're younger, then that might be your solution, right? So then you're looking at, okay, your 9% return, your 1 million grows to 14 million, right? Much bigger return over that 30 years. But you have to then be ready for these wild swings. So in year 24, when your portfolio makes its way, and we're using giant numbers, and so, but it makes its way, let's say $8 million down the road, a 30% correction. So when you're in the stock market in a higher growth portfolio, instead of expecting a 20% correction, you have to prepare for a 30% correction. A 30% correction on an $8 million portfolio is 2.4 million. A 30% correction on a $2.2 million portfolio is almost 700,000, right? So this is part of the price you pay. So when you start looking at volatility, embrace it, own it, understand that that's part of investing. Don't be discouraged by it, even though when we're going through bouts of volatility, that's when it's the most painful. Oh, I know this is the one you've all been waiting for. So the next topic is your political party just lost the election or won. Let me tell you why this should not change your investment strategy. This is definitely the question or comment du jour. This is what we're getting a lot of. And so I don't know if I can change people's mind, but I'm trying to because I don't think this should be what's driving your investment decisions clearly by this slide. Many of you have seen this before. Focus on what you can control. Avoid political noise. Hating the government is not an investment strategy. And then I love this quote by Winston Churchill. Americans always do the right thing, but only after exhausting all other options. So this is annualized performance by president. Sorry if some of these faces create pain for you. But if we look back at these different periods of time, you can see red and blue, and mostly positive gains with some negative gains or some negative years. You can look at the more recent history with Trump and Obama and Bush and Clinton, back to Reagan, right? So you can see the rates of returns. There's no method or madness or method in determining the different returns. It's I don't want to say it's random. Obviously, policy decisions do have an impact, but the message here is that our country has thrived through all kinds of political dynamics. If we then want to take this a step further, similar data going back to 1932, but it really shows like, okay, when we look at performance over the periods of these presidencies, we've had 13, when we look at like negative years, so negative S&P years, 13 during Republicans and 13 versus Democrat. When we look at the average annual return, 8.6 versus 8.5. So pretty much a wash. And we have GDP growth, negative years, meaning a bad economy, 8 red and 7 blue. So it's pretty consistent when you look at that. So we're getting more and more people to be nervous because Biden's the president. We're getting a lot of people who are super excited. So the thing is this should not drive your decision. You should have a financial plan that drives your decisions. The financial plan then dictates your spending habits, your savings habits. Then from there, we create an investment strategy to help you meet your plan and meet your goals. And that's it. This is a lot of noise. I know this is not going to get me out of having conversations with each and every one of you, but just know that the data shows that this should not be a factor in your decision making. I know emotionally it can be, but it should not be. I don't have the updated slide post Biden and post the results with the Senate, now 50-50, which essentially gives the majority to the Democrats. But if you look at this basically shows consumer confidence, by Republicans and Democrats. And what it basically shows is that when we have a Republican in office, the consumer confidence goes up. And then when we for Republicans, and when we have and it goes down for Democrats. And when we have a Democrat in office, it goes down for Republicans and up for Democrats. So it's not true that one group or the other is more confident or more optimistic. It is simply based on confidence, based on political affiliation. And so there's times where it's been elevated. Clearly, when we have economic growth and expansion, then we're gonna see better results across both parties. But when we see economic downturns like the Great Recession, which happened right after Bush, you can see we're looking at confidence rates were really low for a period of time as we kind of grew out of that. So this should not drive your investment decision. That's my final word of advice on this. All right. This is okay. So I'm just moving some more stuff around. Okay. Can I buy individual stocks rather than mutual funds and ETFs? So we don't get this question a lot. We've been getting a little bit more of it, and it's not people wanting to get rid of mutual funds or ETFs. They want stocks in addition. And I think that's happening because of like the Tesla phenomenon and the Zoom phenomenon, a lot of companies that had pretty crazy market growth years. And I will tell you in my time being in this business, when I start getting clients kind of not demanding, but asking these questions, it generally means we're at kind of a cycle change, which means collectively investors do a good job of kind of helping to self-identify where we are in different cycles. And when we start getting a lot of demand, it's kind of that idea of like cocktail party conversation, right? When you're at a cocktail party, and this was, obviously a long time ago, when we used to go to cocktail parties, if people were talking about how much money they made in real estate and how easy it is, that's a troubling sign. When people are talking about how easy and how much money they made in Tesla and some of the, the Zooms and a lot of these companies that were high flyers, that sometimes can be a troubling sign, because when it feels easy or the returns are excessive, that a lot of times is what I think creates market peaks. But again, we're bullish over the next 8 to 10 years. So I'm not suggesting we're here now. This might just be identifying this in a few companies. And so the words of caution is around this idea that Yes, we can own individual companies. That's not a problem. Of course, we can do that. We are licensed in this business to we can buy mutual funds and individual securities. We can do what we think is in the best interest of our clients. One of the things we have to be careful with is around kind of picking things that we think are sure winners when that is not likely the case or not always the case. So we're going to go through some stats on this, try to prove my point. So you may not agree with me on all these, but I want to just kind of prove my point. So if we look at this last year, basically the largest stocks contributed the most in 2020. So 52% of the S&P's return was generated by the top 5 companies. The bottom, and the S&P was up 16%. So the bottom, basically 400, created 9% of that return, which 9% of 16 is like 1.6%. So you can see most of the gains were concentrated in five companies. And Tesla wasn't an example of that because they didn't get added to the S&P till the end of the year. They didn't even get included. But here's what was staggering to me. The title says, Chase individual stocks at your own risk. So if we look at the last individual US stocks, the last 5 years, basically 1,793 stocks were positive and 18,028 were negative. So that means 50.5% of stocks lost money. Then we look at mutual funds. 1,638 were positive, 134 were negative. 7.6 lost money. And then you can see ETFs, 4% lost money. So that was pretty staggering when you actually look at, the benefits of diversification, the benefits of owning, stocks that are in different sectors. You can see the difference between owning them in a diversified fashion and owning them in just individually. So of course we can do this with individual companies. When you start looking at market risk, market volatility, we truly believe in using diversified pools and also using good equity managers who have, teams of analysts that are helping to sift through, the best companies out there and trying to really identify those on our behalf. And that's, I guess, another message too, just to add a little bit more on this is, I do think coming out of COVID, we're going to have a lot of businesses that thrive and grow and really have this growth mindset of being able to achieve anything. And they're going to move forward. They're going to push through. They're going to adapt to change. We're going to have a bunch of companies that aren't. We probably can identify many of those that are going to break through, but we haven't identified all those. We don't know who's going to struggle. And so that's why, again, being more diversified is important because we want to be careful about, having too much confidence in a company because it's been around and maybe they don't change, maybe they don't innovate. And so just I guess a word of caution on that. And, this is another one. I have a chart that I don't think I included in today's, but, today's leaders may not be tomorrow. The technology leaders going back to the 1980s, IBM was on that list. Clearly, IBM is not on that list anymore. And if you look at the largest 3 holdings in the tech sector, Microsoft, Apple, and Visa, and then you compare, then you can see they're 48% of the tech sector. And then you can see 70% or 70 holdings represent 52%. Right, so it's pretty remarkable. You see the top 3 represent 48%. Then if you look at healthcare, J&J, United Health, and Pfizer, 3 companies represent 22%. So you have high concentration. So just be careful about that. And we're happy to have the conversation. We are, we provide investment advice. Our job is to take good care of you and give you sound advice. And so we welcome those conversations, but we do believe it's best to stay broadly diversified because that gives us the best chance over time. All right. I was debating whether this was going to be a topic for a whole presentation, but we're going to do it today in just this section. So next topic, party like it's 1999. Are we on the verge of another dot-com bubble? So let's just talk about reasons to be optimistic. So the short answer is, I think, no, not yet. But as we all know, markets do run their course, runs its course. We do run into periods with all markets where we get speculatively too high and things correct. I don't think we're there right now. And I think there's reasons why there's, still a lot more room to grow. So reasons to be optimistic. So We have the labor market is improving. One of the things that's interesting with what happened with the labor market is, there was really low unemployment and companies were having problems staffing. We've kind of had a reset, and I think finding employees is becoming a little easier now, especially since the unemployment checks aren't quite as big. And so, the labor market is getting better. Housing surge. I mean, if anyone's been trying to buy a house, it's really difficult. If you're selling a house, it's super easy. You're getting above, in a lot of markets, maybe outside of like New York and some big cities, you're seeing really strong housing market. The 30-year fixed mortgage rate is the lowest on record, and we're seeing housing prices, spike up. Pent-up demand, that's a big thing. That's kind of a big theme, I think, of 2021. When people can start spending again, traveling, going to restaurants, getting back to normal life, we have a lot of pent-up demand. This is likely going to find its way back into the economy. And so even though the stock market is, has been a little bit crazy with some of these companies, I think, from a health of the recovery, there's a lot more reasons to be optimistic because of these factors. And then this CapEx boost, which is basically, capital expenditures, is that, they're at really low levels right now, and that we're seeing that expensing now that we have a little bit more clarity of the economic recovery. We're seeing that return, and so we think that the economic data is going to continue to move forward. Here's a big part of one of the reasons for optimism. Look at the amount of money that consumers have in terms of just their balance sheet. Their cash balances are at record highs. You can see here. And I mean, it's tremendous. So all that cash finds its way somewhere, right? It's going to be spent, it's going to be invested, combination of those things, and that drives prices higher, right? So that will likely add some fuel to the fire. And so, these are all just things that are really in the long-term benefit of the economy. So while it's maybe convenient to kind of start drawing some correlation between now and the .com, we just don't think we're there just yet. A couple of things when you start looking at consumer spending and where we are in terms of, we're still well below pre-pandemic levels. So what I'm trying to kind of highlight over here is this circle that shows where we were, how much were people spending, relative to their overall spend. How much would they spend in food services, recreation, transportation, accommodations? We're still well below these levels, 20%, 28, 28, and 57. So we're well below this. And look at what people want to start doing. They want to maybe go back to work. Imagine that. Going back to restaurants, flying on an airplane, massive amounts of pent-up spending. A lot of people who have been working through this whole time and haven't experienced any health setbacks have saved a ton of money. They're not spending as much. This money will find its way back. Right now, I feel like a lot of that's getting invested, which is obviously helping the markets, but it's going to find its way back into the consumption side of things, because Americans, we like to spend money. So this will make its way back in. And then when we start looking at cyclicals, so things that are more tied to the recovery, that are more economically sensitive, we think that a lot of these sectors will do better, that we'll see better earnings growth. And so, those are probably some of the areas that didn't have a great year last year. So that's where maintaining balance in the portfolio makes sense, is because some of the leaders of yesterday may not be the leaders today or this year. Also, we're likely to see the biggest recovery in small companies, the biggest recovery in value companies, because remember, a lot of the tech companies had great years because they were still moving forward. And in fact, they had new demand like they'd never seen because of the work from home. So they've seen really high growth rates. That growth rate, it might continue, but it's not going to accelerate because there's not really a catalyst to do that. But a lot of these other industries that are kind of going through a rebuilding mode, we're likely to see earnings accelerate in those sectors, and that's where we think those parts of the market are going to do well. So again, it's kind of convenient and fun to say party like it's 1999, and are we on the verge of another .com type of environment? And the short answer is no. There's still too much profitability in these tech companies. We're not there yet, but we know human nature, so it's on the horizon, just not in the near future, in our estimate, in our humble opinion. All right, couple more topics, and then we'll wrap it up. I know this was a little bit longer, but it was kind of by design to cover some of these topics. And we're also going to, I think I mentioned, we're going to cut this up and put this into different presentations on social media. So they'll be kind of shortened into hopefully, 10-minute clips. All right. what's being proposed by the Biden administration. So it's a little bit too early because there's a lot of things that are happening, right? So it just was inaugurated, so we don't have full clarity on the plan because obviously it's not just his plans, right? So it's and now that the House and the Senate are controlled by the Democrats, it's going to be a party plan, and so we just don't know what that will be during a Biden administration. So I do want to cover some things that we talked about. So this was kind of the outcome that we laid out at one of our presentations. If we have outcome number one, which was a Dem sweep, which is what happened, what that actually meant. And so, things that we thought were more likely is we were going to start seeing some tax increases. This is kind of down here in the bottom left, tax increases. Those tax increases are likely going to be for households earning more than $400,000. That would include on income and on capital gains and dividends. Likely going to have a much bigger like stimulus package that might focus more on infrastructure. That seems to be the case. I think that's one of the reasons why the markets are doing well, is because they know there's probably more money coming out. Also, the one thing that gets missed a little bit is, Biden's likely going to be giving some more state aid where necessary. Trump was pretty clear about, California or Illinois or New York is like, hey, you've been mismanaging your state. The federal government's not going to bail you out. Well, that's not going to happen under Biden. I think Biden's going to give equal support to the states, whether you think that he should or not. That's neither here nor there. That's likely going to happen. And so we'll probably have, healthcare is going to be a big benefactor of money. I don't know if a public option will really be explored. I know there's talk of that, but I know that's complicated. So I don't know if it's going to be a build on Obamacare and more regulation there or more policy change there. And then probably have decreased trade tensions. Although I do think that Biden might carry some of the strong China policies to favor our U.S. companies here. So less likely spending cuts. Trump cut back on a lot of regulations, which a lot of businesses liked. That's likely going to start to curb and even be overturned. And then, less likely is more support for defense spending. So, people expected, and I probably would put me in that category, that if there was a sweep, that it was going to be negative for the markets. And this is another reason why you don't market time, is it hasn't been. There was a sweep and the markets have moved forward. And out of optimism and kind of consistent with the policy we said is, you just have to not, let the political party drive your decisions. I do want to share a little bit of the proposals on some of the taxes. This hasn't gone through again, meaning this was just the initial plan. So this probably will change, but you can see under the Trump administration, we saw tax rates, go from 15 to 12, 25 to 22, 28 to 24, 33 to 32, right? We see these go down. And then under the Biden proposal right now, just kind of tackling this upper threshold, this 39% range. So still a little bit unknown. I think and I don't think that has a huge impact on the economy. I do think this one's a little bit troubling, as they talked about this long-term capital gains. Been pretty consistent under both administrations, but there is a proposal on incomes above $1 million that the capital gains rate that would go to ordinary income. And I think I read something that it hasn't been above 25% in over like 40 years or 45 years. And, I know for a lot of people, it's like, well, they're above $1 million, they can afford it. But you got to remember, this would be a lot of, let's just say, baby boomers that are selling real estate to relocate, and they have to pay taxes, and maybe they're selling in a wealthy area, and they have to, their whole lifetime of appreciation in a house, they sell it, they're in this higher bracket temporarily because of a transaction, and they have this mass, they will lose 39% federally, and let's say they're in California, 10%, they'll lose 50% of gains, maybe gains that took a lifetime to accumulate, they'll be taxed at 50%. That's also for businesses, right? So businesses that sell, so you have mom and pop that built a business, for 40, 50 years, and now it's worth 5 million, 10 million, 15 million, and they sell it, half of that will be going to the government. So I'm not a big proponent of that, because I still think we can function properly in the 20% range. If they bump it a little bit, that's maybe a conversation, but that 40% number, 39.6, seems really punitive. It can potentially do some more harm than good. All right. You guys have been hanging in there with me, so I appreciate it. I know this is longer than normal. Next topic, what's your focus for 2021? So read a great book called Atomic Habits. That was my first book for the year. I've committed to reading about 25 this year, so I think I'm already down 4 books. If you are kind of just looking for a fun read, just a nice change of I guess, reference in terms of how you think of things, trying to make some breakthroughs, whether it's on changes in your health, work habits, whatever that might be. It was a really easy read. I did enjoy it. So take a look at that book, because I think it could be a really good resource for you. So just a quick things as we look back on 2020, 10 things investors should remember. And, these things are really important. I don't know if I'm gonna use this list every year, but I do think this is something that I will be reflecting on as we head into the future. So number one, take care of yourself. Number two, stay calm and do not panic. Don't make emotionally charged and panicked decisions. Number three, stick to your plan. We created this allocation in calmer times. Don't abandon it now. Don't abandon it when things get tough. Make sure you're properly diversified and know what you own. Remember your time horizon. Number six, have cash on hand for short-term liquidity needs. Number seven, shoot for the stars. Review your risk tolerance, rebalance your portfolio, and tax loss harvest if appropriate. Number eight, dollar cost average. If you have new money that needs to come into the market, just don't dump it in at one time. Start slowly, systematically putting it into the market. It's about percentages, not points. I know the media talks a lot about markets hitting all-time high, the Dow up 300 points, 600 points, 1,000 points. 1,000 point on the Dow now is 4%. In 2009, 1,000 points was 14%. So put that in perspective. And number 10, and probably the most important, remain long-term optimistic. That's what's going to serve us best. And there's always going to be bumps along the way. This was a great year to really reflect and look at that. So hopefully these are just helpful reminders for all of us. So these are our core values at Vance Wealth. Be passionate, positive, and present. Committed to continuous growth. Inspire balance in life. Collaboration drives success. A healthy urgency to get things done. So, I'm confident that we're all going to have a great year ahead of us. And we're always here to help, myself and the whole Vance Wealth team. So thank you so much. I do have a couple questions here. So if anyone's still sticking around, I'm going to do my best to look at some of the Q&A. The question I got was, how will the closing of the Keystone pipeline affect fossil fuel stocks? I mean, by closing the pipeline, it's going to impact jobs, but it should also lower some of the internal supply here. With less supply, that potentially boosts prices up a little bit. Don't know exactly what it'll do to the stocks, but likely it might have an impact on boosting up, because anytime you drop some of the supply or the availability of the supply, that can help prices and potentially move up oil prices, which in turn should move stocks, but not necessarily. So let's see here. There's a couple other questions. Actually, they're just more comments. So you guys have been great. I know this was like drinking through a fire hose. So thank you so much. Thank you for being amazing clients and supporters of us. And if there's anything we can do to make 2021 great, just let us know. Thank you.